All right, let's talk about something you've probably seen everywhere but maybe haven't put a finger on: the rise of the insane car payment. We're going to break down this whole $800 car payment epidemic. So picture this. You're just sitting at a red light, minding your own business, and this massive, brand new $70,000 truck pulls up right next to you. And you just can't help but wonder, how in the world can they afford that? I mean, the payment must be astronomical, right? Well, here's the short and kind of terrifying answer. Most of the time, they can't. They are caught in a financial trap, a cycle that has become shockingly common in the car industry. So let's dive into section 1 and really unravel this mystery. How on earth did we get to a place where people are paying over $1,000 a month for a car? Get this. The average new car payment in America has soared past $700 a month. And that's just the average. For those big trucks and SUVs that everyone seems to be driving, we're talking payments of $900, $1,000, even $1,200. It's wild. To put that into perspective, people are literally spending what could be their rent or even a mortgage payment on a chunk of metal that is guaranteed to lose value every single day. Just think about that for a second. Okay, so what's the magic trick? How is this even possible? Well, it all comes down to something that's quietly changed over the years: the length of the loan. And here's the real secret. Car dealerships and manufacturers have figured something out. They're not really selling you a car anymore. They're selling you a manageable monthly payment. The total price of the car becomes secondary, as long as that monthly number looks okay. You know, it wasn't that long ago that a car loan was 3, maybe 4 years, max. Then it crept up to 5 or 6 years. But today, to make these sky-high prices seem affordable, we're seeing loans stretched out to 7, 8, even 10 years. We're talking 84, 96, even 120 payments. So here's how they get you. Let's take that $70,000 truck. On a traditional 4-year loan, the payment would be huge, right? Probably out of reach for most people. But if you stretch that exact same loan over 8 years, suddenly that monthly payment gets cut way down. It looks affordable. But here's the real kicker. When you're making those affordable $900 payments for 8 long years, you're not paying $70,000 for that truck. Nope, you're actually paying over $86,000. That extra $16,000? Poof, it's just gone. It's pure interest you've paid for the privilege of a lower monthly payment on a car you probably couldn't afford in the first place. Okay, now this is where the situation goes from bad to, well, downright dangerous. This is what leads to something I call the negative equity hamster wheel. The whole problem starts with a brutal, unavoidable fact. Cars lose value, and they lose it fast. A brand new car can lose almost a quarter of its value in the very first year. And after 5 years, it's worth maybe 40% of what you paid for it. Ouch. So, what happens when your car's value is dropping like a rock, but you're still chipping away at a massive 8-year loan? You get what's called negative equity. It's a fancy term for being underwater, which means you owe the bank more money than your car is even worth. And here's how that hamster wheel starts spinning. A few years in, you're tired of your car, but you're still underwater on the loan. So you go to the dealership and they say, no problem, we'll just roll that old debt, that negative equity, right into your new car loan. So now you're paying for a brand new car plus the leftover debt from your last car. And the cycle just gets worse and worse. Look, this isn't just about car debt. The true cost of this cycle is much, much bigger. We're talking about the cost to your future. This really boils down to something called opportunity cost. Every dollar you spend on a massive car payment is a dollar you can't use for something else, like, actually building wealth for your future. Think about it like this. That $800 a month represents a choice. Path number 1, you send it to the car company for a depreciating asset, something that's guaranteed to be worth less and less over time. Or, path number 2, you could invest it in an appreciating asset, something that actually grows your wealth. So what's behind door number 2? Well, what if you had taken that same $800 a month and just put it in a simple, boring index fund? After 7 years, you could have over $70,000. That is the true cost of that shiny new car. You've probably heard the saying that driving a new car off the lot is like lighting your money on fire. The only difference is, in this case, you're stuck making payments on the pile of ashes for the next 7 years. Okay, that was a lot of doom and gloom. But don't worry, there absolutely is a way to break free from this cycle. There's a much smarter path you can take. It's actually pretty simple. First, buy a reliable, used car that someone else has already paid the massive depreciation on. If you have to get a loan, finance it for the shortest possible term you can afford. And then, and this is the most important part, take that massive difference in payment and aggressively invest it for your future. So, at the end of the day, it really comes down to this simple question, a question I want you to ask yourself. Is your car a tool that helps you live your life, or has it become a trap that's quietly stealing from your future? The choice really is yours to make.